All right, guys, well, this is an interesting question for us to answer today. Are there stocks out there that everybody should own in their portfolios? Everybody seems to have an opinion on it, so I'm going to give you my opinion on it today. So let's dig deep into that question today, right after you hit that like button, if you like getting the truth off the hype, because that's exactly what you're going to get today, guys. Obviously, Wall Street has an opinion on this. We'll talk about the stock specifically, and we'll also talk about the concept of should everybody own a particular stock in their portfolio or not as well. So let's dive into the video and see what Wall Street has to say about this.
So glad you're with us on this Monday. We're watching possibly for some records, and we have some great guests for you. As U.S. stock index futures are looking to the upside. We're getting you ready for the trading day. We bring in Wall Street veteran Ted Weisberg, founder of President Seaport Securities, and he has picked notoriously many winners over the years, and you've been on this trading floor for many years. How are you feeling about the market today, Ted?
Well, I'm still feeling good, but this week it's all about the Fed. You know, we have a Fed meeting Tuesday and Wednesday. We'll get the results Wednesday. The futures are telling us we're going to get an interest rate cut, 25 bips. Some people are saying 50. I hope it's 25. But one way or the other, it looks like an interest rate cut is pretty much baked in at this point.
Well, as you can tell as he was speaking, we got thunder going on here. We'll see if we can cut that out in post if you hear it. Sorry, that's what it is. Can't help when the thunder is going to be louder than what the insulation and everything else in here can do. In regards to the Fed and the 25 point, 50 point, whatever, I don't care. Going to cut interest rates, sure. Don't cut them too far. Obviously, we don't need a scenario again where we're going to get ourselves in a lot of trouble, a lot of inflation and everything else. I understand there's a lot of different narratives out there, a lot of different political narratives too. I'm not diving down any of those sorts of things. The Fed is not crazy over the top restrictive right now or anything ridiculous like that I've heard in the past. So sure, give me 25, give me 50, whatever the case is. Don't really care. Obviously, we've been expecting this for a while. More importantly, Powell's been signaling this is coming for a while. So this really shouldn't be a surprise, and nobody should be surprised this week about anything that happens in regards to the Fed decision.
Oh, you would like to see 25, not 50. How will that help?
Well, 25 is probably baked in. And the problem with 50 is if it's 50, then the message to me is more negative than any of us assume. Perhaps they see some weakness in the economy that we, quite frankly, are not aware of. I don't think it's there. And I think a lot of the cut in rates perhaps is more political than necessary, but it is what it is. And overall, the market wants to see lower rates. So I think it's a positive backdrop for the market going forward.
Do you feel?
Yep. Of course, everybody wants lower interest rates. Not going to complain there at all, but he's right. I don't see anything in any of the data that I've come across that's negative. Definitely some things are slowing, maybe not as good as we want, but that's a big difference between that and something that's, 8, 9, 10% inflation, for example, in 2022. But in 2023, everything improved, and same thing with 2024. And of course, here we are in 2025, everything's still remaining strong and stable. So I'm not concerned with it either. He's right. Maybe that could be what they would be signaling with a 50-point basis cut. Like, hey, maybe there's something bigger on the horizon, something coming that they want to get ahead of. But either way, I'm not all that concerned about any of it. I know a lot of folks disagree with me in 2023. I like how it turned out. Same thing in 2024. I like how it turned out again in regards to our investing. And obviously, there's nothing substantial in the way. A lot of the fear and the rhetoric and everything else was far larger than any of the actual impacts of everything that's gone on so far this year, which has been a unique year to say the least. But nonetheless, it's not something I've been concerned with or worried about at all. So I'm right along with this guy so far.
Like the market can continue to move higher or melt up. We've been hitting records.
Well, I would simply say that, in my opinion, what I've learned over the years, and it's been many years, is that the market never, ever lies. The market in general, is a forward-looking indicator, not a trailing indicator, and it tends to discount the future, not the past. And I think the market is simply telling us, Nicole, the strength in the market is telling us that corporate earnings are going to remain robust going forward. And at the end of the day, it is all about corporate earnings, not about anything else, that ultimately will drive the stock market.
There you go. The key to it all, apparently me and this gentleman are on the same wavelength all the way around there. Yeah, that is what matters. Not rhetoric, not macro data, not all this other trash that everybody throws out there with all this different content and everything else. What matters is those earnings. How did I know when to buy banks whenever they were beating down JP Morgan right around $100 per share? How did I know to buy that? Because I looked at the earnings. I listened to the earnings calls and I knew exactly what was going on with the business itself. How did I know to buy a Palantir? Same exact way. How did I know to buy SoFi despite everything being negative around SoFi there for so long it felt like? I'm looking at the earnings. I'm looking at the data that the companies are providing us. And I listen to what they're saying on the earnings calls, not narratives, not geopolitical stuff, not macro this or macro that, or any of that other noise, not what interest rates are doing, not any of those sort of things. Sure, people are always quick to draw pretty little charts and graphs and correlate this and correlate that to tell you what the heck's going to happen next, which clearly, if they worked 100% of the time, that right there, there'd be trillionaire investors. But since there's not, all that sort of stuff was wrong far more than it was right because you're guessing it's 50-50. That means you're going to be right half of the time, which of course you're going to brag about that and then not discuss the other half where you're wrong. So that's why I don't include it at all. Cool, it's a coin flip. That's called gambling. That's not called investing. Investing comes down to those fundamentals. Was I worried about Google at all? Whenever it was just, oh, ChatGPT is going to kill it. Everything's going to kill it. Oh, they're behind in the AI race. All this other crap like that. No, because earnings told me the right story. Earnings told me exactly what was going on with the company. Earnings told me what was actually going on with search, not narratives, not any of the other pretty charts and graphs that everybody was throwing up showing how ChatGPT is killing everything and all this other trash like that. That's why you got to get into those earnings calls and listen to those earnings calls and read through those earnings reports every single quarter. Don't watch recaps. Don't get Luke's opinion on it. Get out there and actually do your own work, your own due diligence. Then you will know and be able to easily spot opportunity and get away from all the other noise that's out there.
And ultimately, you've picked some real winners over the years. I mean, Meta was always one of your darlings that you went after right out at the IPO. What an incredible run it's had. Do you still like a name like Meta?
Yes, we basically, with one exception, we own every share we bought 10 years ago. And, perhaps we're being greedy, but I actually think the stock is going to work higher. And if new clients come into the firm and Meta is priced at some sort of discount, we would probably add.
Yep. Can't disagree there completely. It's not overvalued by any stretch of the imagination. And hey, if you get some sort of a discount, like you said, that's definitely a stock I would be looking to add to as well. We had it last year in the 450 range. You can actually see it right there on their chart. We didn't get that pricing for very long, as you can tell too by that chart, but nonetheless, easy buy, easy opportunity, and really easy money. And I think Meta is just at the very beginning of their growth path forward in regards to WhatsApp monetization. And of course, we're not even talking about anything related to AI or anything else of that nature.
Right now, the high was 796 and change. And right now it's at 755. I mean, do you think this could continue to go higher, break those highs, make new ground in the next, year or two?
Well, I guess the short answer is yes. Otherwise, we'd probably be selling some of the stock.
Yeah.
So we're comfortable with the stock.
Right.
We think it's a reasonably priced, a very high-profile tech name. That and perhaps Google are two stocks that I think should be in, at least with exposure to tech, should probably be in every portfolio.
So there he is right there. He thinks Google and Meta should be in everyone's portfolio. Now we'll talk more at the end there in regards to, should specific stocks be in everyone's portfolio or not? At least I'll give you my opinion on that. But I can't disagree. Those are two great stocks. We've been adding those stocks like crazy over the past really 3 years now because look at what Google's doing, right? We were able to get it in the 150s forever, low 100s forever, obviously below 100 for, several months. So, and these are great long-term companies, great long-term performers, mega cap stocks, and you're getting those types of discounts on those particular companies. So both have been great winners for us, and it's good to see somebody who's able to identify not hype trash, but actual winners in the stock market that are kind of easy money.
Another name you picked was EssilorLuxottica. They make the glasses and Ray-Ban glasses, and then they had all these deals for, glasses with all kinds of special tricks. And this stock has been up over 30% in 1 year. It's a name that you've loved for a long time. Now what? Do you take profits or you stick with it?
No, we're going to stay with it because we think actually it sounds pretty boring because we don't really sell anything. If we get into a good name, we tend to keep it.
Yeah.
But this is
and that's probably why he does pretty well in the stock market and probably outperforms the vast majority of the hedge funds. It's the secret sauce, guys. Buy and hold and just add on the dips when you have a great company. Now, obviously, when your company is having problems or something fundamentally changes or something of that nature, of course, then you want to make sure you get out of that. Or if it's just outside of your circle of competence, or you just don't understand the business on a high level, something of that nature, of course. But generally speaking, when you own a great company, you are going to regret every single share that you sold of that stock. As my journey with Apple is the same exact way. Look back at the chart and tell me, wow, if you bought it in, we'll say 2002, and then you wrote it up to 2014 and 2015, it's hitting these all-time highs after all-time highs. If you sold anywhere along the way, you feel pretty silly. And then just looking at it today, you feel pretty silly as well, despite, thousands upon thousands of percent of gains, which all you had to do to receive those gains was just simply hold the stock. That's it. A lot of folks, I see it in my comments. I also see it in my group members, talk to group members, and we'll see it down there, pop up in the Discord occasionally. Somebody owned a bunch of Palantir at $6, $7, and then of course they sold out at 13 to take profits, or they sold out at 30 to take profits, or whatever the case is. I mean, you talk about massive regret. You had a life-changing stock there, and instead you bought into the Wall Street narrative of taking profits and doing all these little gains, trimming, whatever the case was. And over the long run, with a great company, not hype trash, not something that gets so crazy overvalued, but actual great companies with earnings performance, you always end up regretting the shares that you sell. That's why buy and hold is the best. Statistically, it's the best. Wall Street's done the actual studies. They actually point to, hey, yeah, actually just, hold. Dead people outperform hedge funds. Those are just facts that you can't argue with. And so therefore it's the best strategy, but it's boring and doesn't get a lot of engagement and obviously isn't very sexy or any of those other things of that nature. So, and most Wall Street folks are making their money on the bonus, right? On your money. They're taking off part of your money. And of course, they don't get a bonus if they don't take profits. So therefore, they're taking profits as often as they can to pump up their bonus. And of course, it's not like they get less of a bonus if they happen to lose you money. It's not how it works. They're getting their money regardless. So, yep. So I definitely like the strategy that this guy employs.
The company, and because it's one of the it's a perfect example, in my opinion, of a vertically integrated corporate structure. They merged, Luxottica merged 5 or 6 years ago with Essilor, which is a French company. They make the lenses, Luxottica makes the frames, and of course, and now they're into a lot of different things. Lens crafters in the U.S. I think they have 6,000 or 7,000 outlets. They own Sunglass Hut. I mean, it's a very interesting company. It's not a tech name, but it is a name that is a sector killer in their space.
And it's gone from, over 3 years, it's gone from $66 up to $160. So what an incredible pick that was. What else is on your radar? I know.
Yeah, I don't really have any interest in that stock. Don't know a whole heck of a lot about it, but physical retail goods and retail space, that stuff is all dying, and it's just not a business I necessarily want to be in as heavy as others. Not saying it's a bad company or anything else of that nature. Obviously, people are still going to always want to come in and try on sunglasses, to see how they look on your face and everything else. I understand AI is getting better with, you being able to do virtual type things. But there's probably all going to be a niche for it. And I don't know this management team well enough to know, can they pivot? Can they change? Can they do a lot of other things to keep up with that? Of course, he's talking about vertical integration in regards to getting the product out there. That makes perfect sense as well. It definitely helps out with margins and everything else. So make sure you're doing your due diligence on companies like this. But that's just kind of in terms of where I'm at in my plan and my life and everything else. For what I need for my portfolio, it's just not one that really fits for me. Not saying it's good or bad, just it doesn't fit for me.
You've talked about Oracle, Chubb. What else do you still like?
Now I think
Oracle, great pick.
Yeah. Well, it was been a little bit of a struggle, but we had a good day last week. We've given some of that move back, but the stock
right there, that Oracle piece right there, I'm glad he was honest and was like, he didn't say luck, but basically they made a pick. Oracle didn't do very, very well. Obviously, they didn't have this on the radar at all. So everybody trying to figure out, oh my gosh, could you see this coming? And, how do you find the next Oracle and stuff like that? You don't. You just end up holding a company long enough, sticking with it, watching those fundamentals, more importantly, understanding and trusting that management team to execute on whatever vision they have. And then, of course, you end up with just a ridiculous quarter like Oracle had there, and you get the benefit from that as a shareholder there. So don't really know what he meant. Maybe they're still down on the position overall despite the big jump up. I don't know. But once again, just simply holding a stock over the long run means good things tend to happen overall.
Looking up again today. I mean, Oracle's a terrific company. But going forward, there's a couple of things that we're focused on. Number one, with the prospect of lower interest rates, which seems like a reasonably good bet at this point, we're focusing on, believe it or not, dividend-paying stocks. Because as interest rates come down, those companies that pay generous dividends, and some more generous than others, become more desirable, and it'll tend to have dollars flowing in to those sectors, which should, number one, you'll get the dividends, and number two, there's a good chance for some price appreciation. And one of the areas to look at, which is completely out of favor, are the big pharmaceutical companies, Pfizer, Bristol, Merck. Just as an example, I'm not suggesting any one of those names is a name you want to own, but there's a perfect place to go to get generous dividends with companies with good balance sheets, that are at the moment out of favor, but hopefully, with the benefit of time, will do better. And with interest rates coming down, those big dividends will tend to support the price of the stock.
Yeah, and I mean, some of the Vanguard has a lot of dividend ETFs, and also you have Schwab U.S. Dividend Equity ETF, SCHD, the Vanguard one, VIG, and iShares DJ Dividend DVY, so in the S&P Dividend SDY. So you can take a look at some of those different ETFs for dividend players
Correct.
Overall.
But I think it's something folks should pay attention to, especially in an environment where interest rates are going to be lowered.
And then what about President Trump's?
So you see right there his focus on dividends and kind of creating a play, basically the money coming out of treasuries and going back to more dividend style stocks. It's true. Unfortunately, if you were looking to build out a dividend portfolio, the best time to do it was a couple of years ago, man, because we were getting some stupid, crazy valuations on some incredible dividend paying stocks, solid companies. And some of the dividend paying companies are extremely overvalued right now. So be very, very careful. So I think that's why he kind of pointed towards the pharmaceutical industry specifically, or, just basically healthcare overall, probably is another place you could look because it's out of favor right now. It's out of favor across the board, but you've got to find the gems from the companies that are having problems. You've got to find the companies that are going to be less affected by all the policy changes here in the US versus some of the companies that are going to be heavily affected. And therefore you could be in for years of declining earnings versus finding that diamond in the rough that's going to come out of this, kind of like banking stocks did a few years ago, or, obviously big tech, obviously roaring back last year, and a lot of other things of that nature. That's just kind of what you got to be careful for. That's why just assuming and going in and buying stocks because, it's beaten down, that's buy the dip, right? Whatever the case is, it's not necessarily the case because there's going to be some stocks that are going to struggle and some stocks that obviously are just undervalued and are going to make you money in the long run when that money kind of rotates out of treasuries and moves to some of the safer plays like dividends and stuff of that nature. So you just got to be careful with that. And also make sure that you're following your plan with your stocks, right? If you're 25, why the heck are you buying dividend stocks, right? There's better opportunities out there, and all you want to do is grow your portfolio. You're not interested in the income dividends, give you. Not real. I don't see the point in buying them, at least. I've done that before, trying to be diversified or whatever. All it did was cost me money over the course of 10 or 20 years. Just simply looking at what I could have bought instead and what I did buy instead. If I would have bought more of that, obviously I would have more money today than hanging on to those dividend plays. So keep that in mind. That's why your planning and your goals are so important in buying stocks that align with your goals. All right, so we'll stop the video right there. Now, back to in regards to should everyone own certain stocks in their portfolio. He referenced Google and Meta specifically, but should everybody own, a base 5 stocks or whatever the case is? Everybody should own. To me, that answer is a resounding no. It doesn't make any sense. If you don't understand a business, you are going to get destroyed in the stock market. That is just facts, because when a stock dips, if you don't understand Meta at all, we'll use that as the example here because he mentioned it too, or Google, take your pick. But Meta, if you don't understand what you own, what the business does, how it makes money, future opportunities with Meta to make a lot of money, when it falls from $300 and something, $400 and something, whatever the heck it was in 2021, and in 2022, it falls all the way down to $80, you're not thinking buy the dip, you're thinking I bought the wrong stock. And you're panicking and you're selling out instead of doubling down, tripling down, quadrupling down, and getting an incredible bargain with this stock. That's what I mean by that. I don't own medical stocks. I'm not going to go out there and research that industry, even though I'm curious because I know it's beaten down, right? I know that there's money to be made finding that gem out there in that field, but I don't understand the industry well enough to accurately invest in it. And thankfully, there's hundreds of great companies out there for me to invest in, so I don't have to go outside of my circle of competence to invest in a particular company. I don't have to do that. Instead, I can just wait for other opportunities like we got in Meta, like we got in Google, and other places like that. Just this year, right? SoFi, one I'm intently in. We were able to get that sucker in the 9s just a few months ago. So I don't have to get out there and speculate and go across. I can stick right with what's in my wheelhouse because it is so easy to buy and be excited to buy and not be fearful, but be greedy, right? The old Warren Buffett quote. It is so easy to do when you understand the business on a high level and you understand what you own. But that is not the same for every person. Every single one of us has different competencies, different understandings, understand the business model better, more comfortable with this management team versus that management team, more comfortable with the industry itself. All kinds of things factor into, all of us all have different risk tolerances, right? Some of us have very little, some of us have a lot. All of us have different goals. Some of you guys need income. Well, if you need freaking income, Meta's a terrible dividend payer in regards to income. Not necessarily what you want to be. There's a lot of other companies out there that if I needed income, I would not be looking at Meta or Google for that income. I would be looking in another direction. So all those type things make it, to me, kind of a silly discussion and a silly argument to say everybody should own this, everybody should own that. Makes for a nice clickable thing, I'm sure. But in regards to your actual investing, that's not how you see success over the long run. More importantly, it's not how you spot opportunities when they come in the long run. It's just going to put you in a spot where you end up doing the thing that we always do, which is selling low, selling those lows instead of doubling down if you own a great company there. And remember, if you want to learn exactly how to do that and you stuck around this long, I may have left something special down in the pinned comment down there for you guys, where you get to learn exactly that through free coaching, free courses, be a part of the best 6, 7, and 8-figure Discord out there, be able to jump into my DMs anytime you want, or jump on our live stream. We do those at least weekly. There's so much involved. Check out the pinned comment, see if a membership's right for you. And click this video here if you want to see exactly what I'm buying in this market. And click here to see my exact plan for this market. So thanks for watching, and we'll see you in the next one.